So I just have a quick recap. Last week when we met, we had some discussion about the rate of discount. And if somebody wants to make you wait for the cash arrival, then you know that this will cause you some potential fall in the value of money. It could be that the value of money will go down because normally we live in some kind of, there's always some element of inflation, usually. And not just inflation, there is also a risk element. You get it today, lucky you are. But if you get it tomorrow or day after or in the future, it could be possible that you may not get it at all. So this element of riskiness is incorporated by the word rate of discount. Then we were thinking that, hey, where does this rate of discount come from? Well, the rate of discount comes from a very tried and trusted, the most widely used theory in finance, and that is capital asset pricing model. Capital asset pricing model, I recall, basically tells you that, hey, this is something minimum rate of return which you must generate so that investors stick with you. It's like a hurdle rate. You see what? Daniil, you know hurdle?
Yeah.
Have you seen the hurdle race? You know, the 110-meter hurdle race. What happened there? You jump over the hurdle by a centimeter or by maybe 1 meter above. It doesn't matter. As long as you jump over it, you stay in the competition. But once you touch the hurdle, it will hurt your knee or your what is it called? This thing, ankle, heel, yeah. So it will hurt your heel, right? And what will happen then? You will not be able to run. So one thing is for sure, that you will not win the race. You jump over it by a slight margin or big margin, it doesn't matter. Same way, the financial, the investors, they also have something in mind that, hey, this is the minimum I must receive. And look at the word I'm using. I'm not saying should be received. I'm saying must receive. If I don't get that minimum bar and I get below that, then I would rather not invest. And I will keep that money somewhere else. If I can't get this minimum bar. Same way, think from, not as an investor, think from the point of view of a financial manager. Just imagine you are a CFO of Nokia. And you are inviting investors to invest in your company. You are raising private equity, for example. And you make a calculation that how much I must give to my investors on an average that they invest in Nokia. And it comes out to be that the minimum in the current scenario, the minimum I should generate and I should give the hurdle rate to my investor comes to be 6% a year. And then you ask your question, hey, what is my track record? What's my history? Have I ever been generating 6% in the past 5-6 years? Because it will not happen that there will be some miracle and you start producing 16% this year. No, you have to go in the history. That is why history is very important to make a present decision which have the future repercussions. So the time is very important in finance. Then what you do? You take the data of last 2, 3, 4 years and you do the same thing we did yesterday when we were calculating beta. Beta was one of the different things that we do based on history. We took 2 years data, I think, last year. Well, depends on you. On the horizon, you can take, no problem. And then you are able to make a calculation and conclude that have you been producing 6% on an average historically? If your last 5-6 years average rate of return has been 9, 10, 11%, then I think having 6% in the future is a piece of cake, unless something substantially bad happens. Fernanda, make sense? But if your past track record has always been 3%, 2%, 4%, and you know that this will not go beyond it, it will never go beyond it, then what happens is that it's very less likely that you will be able to generate 6% in the future, unless some miracle happens, right? Miracles do happen. Miracles are possible, but not probable. So that could be another situation. Do you get my point? Yeah. So this is the background that why we calculate rate of discount, and rate of discount come from the very most, I won't say the most sophisticated theory, but very basic level theory, but no one can ever ignore it. And that is called capital asset pricing model. So your first step should be, whenever you want to do the valuation of any company, your first step should be that you are able to calculate CAPM. And look at the formula of CAPM. The formula of CAPM is very simple. Risk-free rate of return. And the risk-free rate of return come from where? You go to your central bank's website and check that what is the 10-year bond rate. If you go to Swami Pankki's website, the Bank of Finland's website, and just check the interest rates data and check what has been last 10-year bond rate. In the current circumstances, I have a strong hunch that it will not be more than 0.5%, because you know we are living in a very low interest rate regime, even though the interest rates have gone slightly up. But it's not that up that it will be 2% or 3%. Yeah, it's not possible. Beta, you know, yesterday we calculated. Did we take Nokia yesterday? Yeah. And do you remember that it was, how much was that? I think it was 1.23. I remember. It was 1.23. The strange thing happened that I just thought when I was cooking up the numbers that beta is 1.23. And then we took the data, we spent good 40 minutes. And guess what, how much beta came? 1.23. So the beta is 1.23, let's keep it up. And then we have the market rate of return. Did we calculate it yesterday? Definitely we did. Remember, we took the data of, what was his name? OMX, NASDAQ. So we took Helsinki 25, yeah? So we took the data of Helsinki 25 and we took the index values and then we found the rate of return based on it. That average rate of return we get is the here RM, expected rate from the market. And RF, you know, is same, you know, it doesn't come to. So what happens then? Let's say that the this comes to be 10%. Hypothetically, and if you put these numbers together, then what you get is, if we assume that the risk-free rate RF is 0.5%, sorry, 0.5%, and RM, the market rate of return, is 10%. Beta equals 1.23. So if you put all these numbers together, 0.5 plus 1.23 multiply 10% minus 0.5%. So you can arrive at this magic number, and this would be how much you said, Daniel? 12.185. How much? 12.185. So let's call it 12.19%. 12.19% is the hurdle now. So the hurdle is 12.19%. And we also discussed, I remember now, last week when we met, that the beauty of CAPM is that there are, if you look at the numbers where they come from, for all the companies in Finland, the risk-free rate would be common. Yeah, Olivia? Risk-free rate for all the companies in Finland would be common, because it's not depending upon company to company. You take this data from Swami Panke's website, for example. So that is common for all the companies, whether it's a small company, big company, that risk-free rate would be same. Yeah. The market portfolio return will also be same for all the companies. Whether you are analyzing Nokia or Finnair, when you take Helsinki 25 index value, that would be common for all the companies. So that is common. Then what is difference? Beta. Beta is the only thing which come from companies differently. For Nokia, it was 1.23. Maybe for Finnair, it could be 0.89. So the only thing which makes the difference is the beta. So it's a very nice combination of the company-specific information, and then you combine with the overall market situation, the two variables, risk-free rate and the market rate of return, which are very general, common to all the companies in the market. And then you combine it with the firm-specific information, and that is beta, which is a measure of market risk. And when you put these numbers together, you arrive at the hurdle rate, the minimum return, which you must generate. Otherwise, you have no right to use the investor's money. If 12.19 is the benchmark, and historically you have never been producing even close to 12%, then you have no right to ask investors to give you money, because it'll be too far-fetching for you. Okay, and if you are an investor, and then you shouldn't invest in these ventures. If you are a corporate finance manager of a company, right, of a big company or a small company, then don't ask investor to give you money, because you will not be able to meet their what I use this word in economics, utility function, the expectation. You will not be able to meet their expectations. That was a background of. So we had discussion last week, but I'm recalling it now that you are able to get track of it. And then we are able to, well, we are able to do many things. And then we are able to calculate the weighted average cost of capital, WACC, the weighted average cost of capital. And just imagine that your average rate of interest on debt, now I'm using the word debt, has been 5%. So RD has been 5%. Just imagine. I should actually write it down, because in the whiteboard, if the rate of if the return on debt, just look at the cursor where I'm moving, so that can you write it down, these numbers in your somewhere, so that we don't forget them. If the debt rate is 5%, if the rate on debt is 5%, tax rate is 25%. Tax which? The corporate tax rate. And what is corporate tax rate? That income tax which companies pay. Corporate tax rate is that income tax which the companies pay. And if this is 25%, and the cost of debt RD in this slide is 5%. And how much is RE, by the way, here? Any ideas? How much is RE? You have done the calculation some minutes ago.
Oh yeah, 12.19.
12.19%, because CAPM helps you to calculate the minimum or return on equity or the cost of equity. So when you use the CAPM, so remember that this RE, I have a look at the slide. This RE, which we use in the weighted average cost of capital, comes from CAPM. Look at this. I'm using the same expression RE here and RE here. So RE come from CAPM generally. There are many other theories, arbitrage pricing theory, dividend discount. There are many other variables, Gordon's model, but I will not go into that. I will only go once you choose your thesis topics. So that you do. So anyway, CAPM is the best tool, simplest, and at the same time, the best tool. And then one more information that the company is 70% financed by equity and 30% financed by debt. I hope you know that a company is financed by equity and debt. 70% equity, which means the WE, the weight of equity, is 70%, and WD, the weight of debt, is 30%. Remember, this is weight of equity. So this is 70%. Weight of equity 70%. RE, you said 12.19. It means the weight of debt is 30%. Tax rate is 25%. And the cost of debt, RD, is 5%. So then all the information you have, then how much? 9.66. So it means that your WACC is 9.66. This would be used as your rate of discount. Yeah. So when you make the calculations, when you make a forecast of the future cash flows, then the rate of discount that you'll be using would be 9.66%. So that is the idea of the rate of discount. It could be possible. It could be possible that number one situation, the company doesn't have any debt at all. It could be possible that the company doesn't have any debt at all. In that situation, your only rate of discount would be RE, because there is no debt. So then this part of the equation becomes redundant, useless, because the company doesn't have any debt. It could be possible. There are many companies where the debt is either very low, almost negligible, or they don't have at all. For example, many companies which come from IT industry or the intellectual capital based industries, they are not very much debt friendly, or maybe the debt doesn't like them. Because the second situation is the language of the question changes, and this is very important now. If I ask you a question, my dear researchers, can you find the rate of discount, or can you evaluate the company as such? Then your rate of discount should be WACC, the weighted average cost of capital, the equation 2 here. But if I rephrase my question and say, my dear friends, I want you to evaluate the company's equity only. What is the theoretical share price? What is theoretical notional equilibrium share price? What do you think is the fair price of this share stock? Am I talking about debt now? No. So in that case also, your rate of discount would be, oh, no, 12 point. Was it 12 point? What was RE?
19. 12.19.
Yeah, then your rate of discount would be this, which is equal to RE. Because I'm specifying that only, even though the company has debt, but what I'm asking you to do is calculate the fair price or the theoretical price of the company's equity, calculate the theoretical price of Finnair's equity. So in that case, you will be only using the RE as a discount factor. Make sense? So remember, we will only use WACC when I asked you to evaluate the company per se as such. But just in case the company has no debt, well, anyway, then this term which I highlighted would be 0. Or if it is very small, negligible, it doesn't matter. But if I ask you to calculate the value of the company's equity, it means I'm not even asking you to include debt, because even though it has debt, we only focus on RE. We move on. And I straight away take you to the formulation now. Example, and we will do it slowly. There are some slides, but I know that you can do by yourself, not a big deal. General Motors, GM, whose ticker or symbol in New York Stock Exchange is GM, is likely to pay $2 dividend next year. So there is a lot of, either you can see some report which says that GM would pay $2 in future, or you can calculate by yourself. You can make an estimate that how much GM has been paying dividend in the past and how much they would pay in the future. Is likely to pay $2 dividend next year, and that you expect that the GM stock to be $58 in 1 year. And you have a strong estimate that GM's stock would be $58 in 1 year. The required rate of return on GM stock is 10%. Required rate of return. Where does this required rate of return comes from? CAPM. So this is the word. Look at the word, required rate. So this basically symbolizing minimum required rate of return. That required, I can't use minimum all the time. So basically it means that this is the benchmark, or this is the hurdle rate, 10%. More than 10%, nobody's angry, everybody's happy. But minimum, the bare minimum should be 10%. What is your estimate, the value of the GM stock in the future? What is the current, how much you see that how much should be the value of the GM stock now? And look at the formula. The formula is very simple. The formula is that if an investor has GM stock today and his time frame, can you tell me what is the time frame in investor's mind based on this question? 1 year. So he's only thinking about 1 year. So if you have GM stock and you have all the estimates and you are planning to stay with GM or not to stay with GM based on 1 year, yeah, then what do? How many cash flows will you receive next year? If you have GM stock and you planning to sell next year, how many cash flows will you receive next year? I'm not asking how much, but how many cash flows will you receive in the future? Any idea? 2? Daniil is saying 2. Make mistakes here. Come on, don't shy. Say it. Nobody's going to criticize you. Any guesses? Ivan? Two. Yeah. Because if I have GM stock now, and what are these two flows?
So you're going to receive some dividends from them, and after that, you're going to sell the stock.
Yes. So I have GM stock. I wait for 1 year. Next year, what I would get? I would get dividend. Once I get dividend, say, oh, I'm happy. Okay, sell the stock. Then I get price for the stock. So two cash flows. But the problem is that these two cash flows, are you getting it now? In the future? There is a risk of everything. And where do you, then you have to use the rate of discount. And where is the rate of discount here? CAPM. Required rate of, look at the word, the required rate of return. It means this will be used as a rate of discount. And then what we do here, as you can see in this, see the cursor where I'm moving. And remember, you are doing this exercise after 1 year or now? Now, because why would you wait after 1 year? Things you do now. And that is why, look at this word V subscript 0. What is in the foot of V? 1 or 0? What is that, Fernanda? What is V? V0 or V1? What is in the foot of V? See the slide. 0. V0, right? What do you mean by 0 in finance? In the current period, present is always called 0. And if I want to show in finance, yesterday or the previous period, how would I show? -1. Next period, 1. The following period, 2 and 3, and so on till nth period. So whenever you see that there is some number, and if you put at the base of the letter, we always call it, what is the expression? We call it subscript. And if I, for example, write V1, then it's called superscript. But generally, the time is written as a subscript, as a lower, it's called something lowercase, I think, in the word, if you, lowercase, yeah. So I would be receiving, as Daniel very rightly said, we would be receiving cash flows, two cash flows in the future after 1 year. So there is a, if it says that you receive dividend and cash flow, price of the stock right now, there's no concept of rate of discount. There's no risk. Come on, it's a matter of 2 minutes. But if I have to wait for 1 year and more period, then comes the rate of discount. And in this case, because we are only talking about the stock, look, he's saying, what would be the value of the stock? What is the fair value of stock? So I'm not talking about debt. Hence, I'm not talking about weighted average cost of capital. I'm only talking about the fair value of the equity. So what we do here, well, we have D1 after 1 period. Remember, when I say 1, 2, 3, they're not always years. If you are making analysis based on daily periods, day 1, day 2, day 3, then you will write D1, D2, D3 as the day. Then 1, 2, 3 would be meaning days. If I do the analysis period 1 month, then 1 month, 2 months, 3 months, 1, 2, 3. If I say years, again 1, 2, 3. So don't get confused that D1 or the 1, 2, 3 are always years. No, they are periods, time span, okay, which can be a day. Even people do intraday trading, right? In that case, your 1, 2, 3 would be maybe minutes. So it depends how you proceed. Okay, so you receive two cash flows, D1 and P1, but don't just add D1 and P1. Don't just add D1 and P1, because this, Olivia, these you will receive after 1 year, right? So there is a risk. Several things can happen between 1 year. There is a gap between, what does it say? there's a gap between cup and the lip. So everything can happen in between. So how we bring this element of risk in the picture? With discount with 1 plus R. Right? R, rate of discount. And what is rate of discount? It comes from CAPM, Capital Asset Pricing Model. Okay, which we discussed on the previous slide. So, sorry, I'm mixing everything. So it's I can write it again. It's there in the formula, but in the slide. So I'm not doing anything new. Plus P1. And just imagine if I rephrase this statement and I say General Motor, blah, 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 after 2 years, not 1 year, but after 2 years, then I will put to the power of 2. So then you have to wait for longer. So the risk is more. So you multiply rate of discount 2 times. Okay. So once you put all these numbers, you do the number crunching. But now I hope that you know the logic of the formula, that why do we have R in the picture? A layman who have no idea of rate of discount would say, okay, 2 cash flows after 1 year, 1 cash flow is this, the other cash flow is that, add this and that, and there we go. But no, there's a risk. And this comes out to be 54.55. 54.55. It means what? The fair price, the justified price of GM stock right now is $54.55. And remember, this is the theoretical price, the fair price. It's not necessarily the real price. And guess what happens? When you do this calculation, you see the, hey, just check on some website, and it comes out to be that actually today, GM is trading at $60, right? Now your actual price is 60. Your theoretical price is 54.55. I can say that GM is overpriced by $5.45. And if I find that the real price in the market right now is $50, then we can say that GM is underpriced by $4.55. So this is how we can compare. The theory gives you a benchmark. Otherwise, if we don't have the theory and the price is whether 50 or 60, we will never be able to find out. Of course, we can compare the price of one period, one actual price yesterday, one actual price today, one actual price tomorrow. We can compare over a time period, whether it increased or decreased, but we will never be able to find out what is the fair price of GM. Theory gives us the fair price, something to compare with, a benchmark price. Sound sense? Good. Now I want to give you a question, but please tell me if you have any query about it. If you don't have, I want you to do one exercise by yourself. Actually, we can do one more example and then we can do the exercise. Or perhaps we don't need. All right. Yep. Oh, yeah, sure. But let's do, okay, we can do this way then. All right, I have a. Sorry?
Here's an example of GM.
Given
the rate of return up to 10%. How can I quantify myself?
Given the 10%?
Yeah.
Use CAPM.
Oh, okay.
Capital Asset Pricing Model. We will do it. We will do it in financial management lecture next week. Yesterday, I was only focusing on beta. But remember, beta is the most important part of CAPM. Yeah, if you look at this formula of CAPM, you see everything else from website, but there is no only thing which you need to calculate is beta. And remember the market rate of return. And we did this yesterday, by the way. Remember, we calculated, we had the stock return of Nokia.
Yeah.
We just need to find the average, and that's it. So that would be your market rate of return. Yeah, but don't you worry, we'll come back to these things many times. We will be moving in a very cyclical manner. Okay, now I want you to do a question for me, and write down the statement. The risk-free rate of return, I speak slowly so that you can write it down, yeah? Let's put it this way. Okay, let me revise. The 10-year bond rate, the 10-year bond rate in Finland is 0.2%. I also write on the board, but just in case I also forget. The 10-year bond rate in Finland is 0.2%. Nokia has been having, next sentence, Nokia has been having its beta. Nokia has been having its beta equals to 1.23. The average annual growth rate of Helsinki 25, you know Helsinki 25, the index, the average annual growth of Helsinki 25 is 8.5%. It is estimated that in 2 years' time, Nokia would be trading at 35 euros, yeah, and investors would get and the investors would get euro 1 as dividend. Yep. Full stop. Last sentence. The current price of Nokia, is 33 euro. 33 euro. Sorry, one more sentence. Is Nokia overpriced / underpriced? Is Nokia overpriced / underpriced? Good luck. Look, Katil. And I give you about 10 minutes to do it. So you have time. And in between, I take a pause and I would keep looking what you guys are doing. And so would be me and Stefan and Tatiana. Okay, folks, so I plan to do this calculation now. So let's do it together. And let's assume that all goes well. But if you guys have any issues and concerns, you can just speak out loud and I would explain it again. But I'm sharing my Excel with you. The risk-free rate was 0.2%. Okay. Let's put the percentage sign. And what was the other information? Follow on. What was the second sentence I spoke?
Nokia has been having beta.
Nokia's beta, okay, beta is how much? 0.23, okay. And the Helsinki 25 index is expected to grow or has been growing in the past. I mean, yeah, so we can even assume that what has been growth rate in the past would continue in the future as well. So we can say that the RM, the market rate of growth, is how much? 5%. Okay. And then what else was?
Estimated that in 2 years' time, not to be trading at it's really 5.
So we assume that the P2 price, yeah, P2 means the price in 2 years period. How much will it be? 35. Okay, I call it 35. And dividend €1 here, because the dividend in 2 years will be 1. Yeah. So D2 is equal to 1. Why I'm writing 2? Because it's in 2-year period. So our time window is 2 years, right? So first of all, we need to find out what is the required rate of return. And the required rate of return is basically the CAPM formula application. And if you look at the slides, the CAPM is equal to, let me call it required rate of return. Required rate of return. And I can say that this is the one which you calculate by using CAPM formula model. And how we get it? It's first equal to risk-free rate, which is equal to this, plus beta, it's 1.23, multiply. So I put multiplication in the brackets, the expected rate of growth of the market. And how much is this?
8.5.
Yeah. Why can't I see 8.5 here? Oh, it's here. Sorry. 8.5 minus risk-free rate. The bracket closes. And there you go. 10.41. 10.41 is our required rate of return. I can highlight the formula just in case you are confused. RF is 0.2%. I would share this with you. Don't worry. You don't have to take any pictures. Beta is 1.23, and as for some weird reasons, RM is not showing up, but RM is 8.5. And when I put all these numbers together, it comes to be, I just applied CAPM model. It comes to be 10.41. It means that the riskiness for the next 2 years is 10.41 for each year. And then we assume that in 2 years' time, we are likely to get what? A stock price. And by the way, what is the current price? May I know it? What is the current price? 33. May I ask you what numeral I would write below P if it is a current price? 0, because 0 is the representation of now, present. All right, so let's find out the usual formula. Let's find the value of the Nokia stock in 2 years' time. The present, remember, we are finding the present value of the expected stock price of Nokia in 2 years' time. And this will be equal to, because you will have two cash streams. So you get 35 and 1. Yeah, am I right? 35 and 1. But remember, use the brackets. Now this, no finance textbook would teach you why we use the brackets. But then you have to recall your high school maths, that if you want to make some combined multiplication or combined subtraction or whatever, you use the brackets. Otherwise, one component would be functioned and the other will be dysfunctional. So this is a mathematical property. So what I would use, bracket P2 plus D2 divided by, again bracket, because 1 plus R is a one term, 1 plus the rate of, is R. And this here, I would be making a mistake if I don't write to the power of 2, because in this question, our time horizon is 2 years. So I put to the power of 2. And I find the V0, the fair value. I can call this value as a theoretical price. There are many names for it. Theoretical price, intrinsic price, even the fair price. Why not? Or the notional price. This is the price we get. This is the price that should be, in theory. In the books, this should be the price of Nokia. But what we see that the actual price of Nokia is 33. So actual is more than theoretical. And if I subtract these two, the actual price minus the fair price, it comes to be positive. And I can say that Nokia is overpriced stock. The price, what the common sense or the theory says, this should be the price. If the markets in the world are perfectly perfect, there's no market friction, the information symmetry exists, then believe me, at every point of time, the real price, the actual price would be same as the theoretical price. But we know that no matter how advanced, how technological development have taken place in the financial markets, but there would always be some anomaly that the human factor would always remain. Some people would be more informed than others. Some people would be having more power than others. Some people would be taking better decisions than others. So that is why this anomaly would always exist. So there would always be a gap between the price, which is by theory, and the price, which is a reality. And the difference between them would show whether it's overpriced or underpriced. If this number was negative, means the actual price is less than the theoretical price, then I would say it's underpriced. But as you can see that the actual price is 33. The theory price, the price that should be, is 29 something. And we say that Nokia is overpriced. Huh? Here.
Yeah, then.
Because you have two cash flows.
I mean, not here, like in the overprice.
Ah.
8 minus 11. Oh, right. Yeah.
P0 is the actual price prevailing now. And the G, whatever is the price that should be. So this is the valuation of the equity price.
So basically, we should subtract the current price minus, no, we should subtract from the B0.
Yeah, because usually we say that the actual minus theory. I don't mind if you write theory minus actual as long as your interpretation is correct. But I have seen many books which always, when they compare between reality and theory, they always write reality minus theory. So, but that doesn't change anything. So I know what you're done opposite, but your interpretation is still same. So that makes no difference at all. So don't worry about it. So my friends who are following us online, do you have any questions about this valuation of Nokia price? Or are you convinced that you're fine with this? I would be saving this file, don't you worry. I would save this file and I would uploading it in Moodle. So you will keep it. But Olivia, do you understand the idea?
Yeah, I counted it.
Yeah, it's not first time you understand. It goes with.
I got the answer pretty close still. Like I wrote I counted it what we different. I got 29 and 28.
Okay, well, that's, yeah. So I save this file in my folder so that it doesn't disappear. I don't want to. Okay. Finance track. And I should call it valuation of Nokia stock. Nokia stock. And once I go to my desk, I would upload it in Moodle. Yeah. Okay. Shiny has asked next question actually. Am I recording it?
Yes.
Oh, I'm recording it. Shiny asked a very important question that what happens next if you find that something is overpriced or underpriced? I want to ask you something. Imagine you bought a house for 100,000, right? Or you're planning, or let's say this way, that you have a house, you know that because you know that there is some dampness or whatever inside, you know, because you've been living in the house for many years now, and you know that this house genuine price is 150,000 euros. Yeah. And then you find that in the market, if somebody is willing to buy the same house from you, is the market price is 175,000. Is your house overpriced or underpriced? It's overpriced because you know that. No, Shiny. You know that the genuine price, the theoretical price of the house is 150,000. When you make the evaluation, because you've been living in the house, you know that, hey, even though the facade is very beautiful, but I know that there is a lot of moisture inside. Okay, and then there is an offer. Somebody is offering you, hey, I'm willing to buy your house for 175,000. Is your house overpriced or underpriced? Overpriced. What would you react? What would be your reactions? Somebody is giving you more price than what you think.
Sell.
Sell. Look, again, don't be too fast to make a decision. You will either sell immediately, or you will start thinking, hey, people are offering me more than what I deserve. Why don't I wait for more time? If somebody is offering me 175,000, which is worth 150, maybe after some time, somebody would be offering me 200,000. Perhaps there is a housing market boom going on. Isn't it?
There's also a possibility that someone notices that your
Yeah.
house is full of mold.
Yes, yeah. But
That's the way it goes down.
that is the risk.
Yeah.
If you are very brave, if you're not really, you're not in a rush to make a decision, then you may wait and stop your neighbors visiting you. If they want, if they can spot the mold and start, writing in the blogs on Facebook, But if you think that, hey, this is a temporary phase, it's like a jackpot and I should sell and get rid of. Yeah. So yeah, you can make all types of decisions. So the same thing happens. If you find that Nokia is worth 29, but it's selling at 33, if you are a value-based investor, and now it's a very important thing. If you find that your stock is overvalued, if you are a value-based investor, perhaps you would do what many of you think, that you sell it. If you're a growth-based investor, it may mean that the Nokia is yet to grow even more. So not 33, maybe tomorrow it gets 36. Day after it becomes 40. So you rather wait and see that if you are so staunch believer that Nokia would grow, then you would rather not, you will put on hold. Remember, we have three reactions in the financial markets. When we have some asset, financial asset, you buy it if you don't have it, you sell it if you have it, or you hold it. I have something, but I'm looking at the market price, but I'm not making a decision yet. I'm holding it. And there's still one fourth decision you can do. You buy, you sell it, even if you don't have it. Do you know that? You may buy something which you don't have. I don't have a green jacket. I can go in the market and buy it. I have something. I have some old computer. I don't want to sell it. I want to hold it. I have a whole old computer. I have it. I go and sell it. Or I have it and I don't want to sell it. Hold it. Yeah. See, there are different combinations. It could be possible that I sell something which I don't have. How's it possible? Just imagine, you don't own a house. You don't own a house. You don't own a house. And you know that the house prices are going up quite fast. Can you still gain? Can you still do something? What would you do?
So you can just book a house for a special price with like this owner. At the same time, you're trying to resell it again. As we're waiting for some time, for example, for several months, the price is going up, and someone is writing you that you would like to buy your house. Now it's yours, but theoretically it's still the owner's one.
Now you're explaining in terms of the registration process.
You can sell it as everything on that is as a stock. The same, you can sell it, and when the price is going down, when it's becoming cheap, you can buy it.
Maybe housing was not a good example, but in the stock market, it happens. That just imagine that the Nokia prices are going up, Fernanda, really up, and I don't have Nokia at all. I'm just repenting. Oh my gosh, I wish I had bought it a month ago. So I'm repenting, right? But I don't have to repent. I can still do something. Because when do you do the trading? You never go yourself in the stock market. You always do the trading through your agents, and agents does through the broker. So all your dealings are through your agent. And you have some kind of bank account with the agent. If I'm the agent and you all are stock traders, then when you buy something, you never take them home. If you buy some shares, never take them home. They remain in my locker, basically. Okay. And you also have your money with me, some trading margin I have with me. You say, you come to me and say, Shab, you have anybody's Nokia lying, and I can lend it to you. I'm lending it to you on the promise that in 3 days' time, you bring it back. What you do? What would you do then? You take it, you sell it, and gain money, okay? But then remember, you have to bring it back in 3 days' time. Yeah. Now, it could be possible that in 3 days' time, it goes down and you win. But it could be possible that in 3 days' time, it goes even high. So you have to buy it even more expensive. Yeah, so that's your risk. Mates, you chose me, you chose to trade. So you bear the risk. I fulfilled my friendship with you. You asked for something which you don't own. I lent you something, but you have to return it in 3 days' time. Huh? Yeah, it's like a borrowing. Look, you can also say that when you borrow from the bank, even that is called, we use the word short selling. Short selling is something when you sell something, but you don't have it. We use these phrases in finance quite a lot. Long position when you buy something, and short position when you sell something. So shorting, longing, these are the words we use quite. But short selling in the strict sense of the word means you sell something, but you are not owning it. You sell something on the promise that you will close your position in 3 days' time. Now, in 3 days' time, the price can go up or down. If it goes up, you lose. If it goes down, you win. Yesterday, Nokia's price was 20. Today, it went 35. You do short selling, you borrow from me this share, Fernanda, you sell it, you make margin, right? But then what happens? You gain $15 gain, euros gain, right? But then what happened that after 3 days' time, when you promise to return this stock to me, the price goes down, value goes down. So you buy it cheaper and you win, right? Or it could be possible the day after, when you return it, the price is not 35, but rather 65. So then you have to buy it expensive. So there is a risk element. Yeah. You good? All good? Let's take a break. And when we come back, we will learn a couple of more, but something related. Remember, now you have done almost 90% of valuation already. Okay. And now what we do next when we meet after the break, we will do a little bit of more example and slight bit of flirting with the numbers. But the idea would still be same, that never forget CAPM as a rate of discount. And always keep in mind, what is the time period of your, the time horizon, 1 year, 2 years. So if you remember these basics, I don't think there would be ever a problem. So let's take a break. Now it's 11:15. So we come back by, let's take a good, decent 20 minutes break. So we start at 11:35. Uh, 12. So, all right, folks, so we meet soon. You need to go? Yeah.
Not yet.
Okay.
First of all, thank you for email.
Shaq, please stop recording. I hope.
All right, my lovely friends. I knew that you were missing me a lot for the last 15 minutes, so I thought I should come back on camera. Olivia is laughing. I'm very happy that Olivia has joined our track, first of all. I'm very happy. Just before the break, or just soon after the break started, Ivan asked me a question about weighted average cost of capital, that how do we do it? I have an example template, which I want to show how we do the calculations. And for some time, we will stick to the weighted average cost of capital. And I repeat that with one method that you've done about valuation, I assume that if you have understood these couple of examples, which we did today, you have understood nearly 90% of the theory of valuation, and with some calculations also. They're not just some calculation, but this is how the calculation process continues. So even in the future, when we do some second method or third method or fourth method, the spirit would be same. The core idea would still be the same, and which is how far you see and how you quantify the qualitative phenomenon of risk, how you bind the riskiness into one number, the rate of discount. Okay. Now, because Ivan asked me about weighted average cost of capital, so for the remaining period, I want to focus on that, if it is okay with you. And I have already uploaded, by the way, this Nokia valuations file in Moodle. If you refresh, you will see it. I have also uploaded this weighted average cost of capital file, which I'm going to discuss it now. You can check if I have done it already, or if not. If not, then I will do it. Or let me quickly see if I have. No. Let me first do it before I discuss. So let me add this file first to Moodle, and then, because otherwise I'll forget. My memory can be frightening at times. WACC, where is WACC? Here we go, the weighted average cost of capital. And is it not very old file, I guess? No, last year, so it's fine. Right. So now if you refresh your Moodle course contents and study material folder, you will find there are 3 spreadsheets already. But anyways, that's not my purpose. My purpose is to study live with this WACC thing. Okay, I open it and then I share it with you. Share screen, weighted average cost of capital. If you look at the slide formula of weighted average cost of capital, you will see that we need total debt and total equity of the company. Remember, in that formula, you can check on the slide. While you're looking at this, I suggest you guys to go to the valuation slides and see the formula WACC, which was equation number 2, just below the CAPM formula. So I would say that you should have that also in front of you so that you can compare. The first input you need to calculate weighted average cost of capital is check the amount of debt. And in between, you also look at what I'm doing so that you have to maneuver. Debt, you see in the balance sheet on the liability side of the company data. There is and by the way, if you look at the liabilities, there are current liabilities and then there are non-current liabilities. I think we did quite extensively in management accounting course. Current liabilities are those which mature before 365th day. And the non-current liabilities are those which mature after a year, basically, a year or after a year, 365 days or more, yeah? When you look your current liabilities and non-current liabilities, you will see some words. It could be called debt or borrowing or finance debt, or even there's one more phrase I have been observing for the last few years. It's called interest-bearing liabilities. Interest-bearing liabilities. And in some cases, I've even seen the expression finance lease. So these could be different phrases. So don't get frightened. But I think once you see a couple of times, if you know your company and you've been observing its financial statements for a long time, you will not miss out. And if you miss out, come to me. And in this task, in this Utrecht project, now I'm talking about Utrecht project, since you only take 2 companies, so it's not easy, it's not so difficult to be friendly with those phrases and words. Yeah, so that shouldn't be a problem. Anyway, and one thing I want to say, that there's one school of thought among accounting researchers who say that when you want to calculate debt for the purpose of weighted average cost of capital, don't include the current debt. So only take the non-current debt, right? But then we also have another school of thought who say, no, debt is a debt. Come on. You borrow for a day, you borrow for 10 years. The rationale is same. And those who say that you only take the non-current debt as a real debt for the calculation purpose, their argument is that the current debt is more like a routine nature, your personal relationship with the bank. So that is not a very big problem. But whatever you do, choose one formula and stick with this. If some of you are only taking non-current debt as a debt, it's fine. But then don't change it for the next year. So whatever route you follow, you want to calculate debt equal to non-current debt or debt equal to current plus non-current debt. Whatever approach you follow, stick with it consistently. Both, none of them is wrong. Make sense? And now you know that where debt comes from. Debt comes from the liability side of the balance sheet. And I also told you different synonyms that how we can address them. Since you all are dealing same company, so in case you don't understand the phrase, you can ask your colleagues and you can come to me. You can even ask help from the other groups or me or my other colleagues here. And the equity is very simple. There's no other name for equity, except that sometimes they say shareholders equity, but equity is equity, right? So I don't know which company was this, but I've forgotten. But I took this calculation last year. Huh? Was it Finnair? Oh yes, it was Finnair last year when we were doing. Good. So good that somebody remembers. Daniil has a supersonic memory, isn't it? I mean, he can remember the whole algorithm of maybe some space shuttle. So we have equity, right? And then we have the value, of course, sum of debt plus sum of equity, as simple as that. And then we have debt and equity. So we can calculate a ratio called debt to equity, which is 0.25. So 0.25 means that for every €1 of equity that Finnair has, it borrows 25 cents as well. Okay. Then we calculated the TC, and this TC, if you see from this formula in this WACC slide, this is called corporate income tax, the tax which companies pay. And I warned you from doing something. I warned you that if you take a Finnish company and you want to find the corporate tax in Finland, and you Google what is corporate tax in Finland, and you find some number from some website and you show it, I would not be very amused. Because in reality, each company pays different tax percentage. There is a headline tax rate, but the real tax rate is varying from company to company. And this tax rate, which is not headline, but it varies from company to company, is called effective tax rate or marginal tax rate. So remember, you can see this word effective or marginal even on the slide. Can you see it? Did I write it, Olivia? In the slide? Marginal / effective tax rate. So I didn't write tax rate. I said marginal / effective tax rate. And how do you get it, by the way? Listen carefully. Go to the income statement of the company. Go to the income statement of the company. Calculate how much euros amount they pay tax. Divide by profit before tax or the earnings before tax, same thing. The earnings before tax, use that earnings before tax as a divider, divide amount of tax by the profit or the earnings before tax. Just hypothetically, a company's profit before tax is 100 euros and it pays 25 euros as a tax. Profit before tax is 100. The tax it pays is 25. 25 divided by 100 is 25%. Then the percentage, the effective tax rate this company pays is 25%. Even though when you Google the tax rate figure of the country in which this company is based, may be different. Make sense? Then I will not say anything about RE because you know what is this? This is the CAPM rate of return. And this is called the minimum required rate of return. Okay. And then RD is the debt rate, the interest on debt. Okay. The interest on debt. How do we get it? Very simple. Very simple. Go to your income statement. See how much interest you pay. And where do you see the amount of interest you pay? After you calculate your operating profit, the next thing is, there's a word called, in some statement, they use the phrase interest expenses. But more frequently, I have seen the phrase is finance cost or finance expenses. That is your interest expense. Divide those finance cost or interest expense, which you get from the income statement, by the way. Divide that by total amount of debt. So imagine this company has a debt of, how much is this? Is it 10 million? 1, 2, 3, yeah, 1 million, yeah? It's 1 million, yeah?
1 million. Yeah.
1 million. And how much debt it pays? Interest it pays? 7%. So I would assume that somewhere I would read finance cost equals 1, 2, 3, and 4. So if you divide finance cost, you know, that is what I said, yeah? So if you divide finance cost by the amount of debt, that would give you the debt rate. I repeat, in most of the income statements of the companies, they never say the word interest expense or interest cost. They usually write finance cost or finance expense. But have a look at the company and bring to my notice if you don't find it. Okay, now we have everything, right? Do we have everything now? And then we use this formula. Sorry, I forgot one thing. There is one more word, more phrase, weight of debt and weight of equity. Okay, and what is weight of debt? The percentage of debt in the total value of the company. So you can see that the company is 20% debt financed, and 80% equity financed. Does it make sense? 1 million debt, 4 million equity, total value 5. It means debt weight is 20%, equity weight is 80%. And then you put these numbers here. And what is the number? Weight of equity multiplied by the cost of equity plus weight of debt 1 minus corporate tax rate multiplied by cost of debt. And this would give you, sorry, why would somebody call me during my teaching? Sorry about this. This would give us weighted average cost of capital, which is 9.71%. And actually, I didn't see it. This is how we calculate debt, assets minus equity, TC and RE. So basically, you have even the formulation that where this come from. And what was this 4.5%? Yeah, 9.71%. Okay, the weighted average cost of capital. I would say that when you go home today, not only look at the exercise we have been doing since morning about valuation, and I think possibly if you could watch the recording, I would share with you. But also have a look at these spreadsheets. 2 spreadsheets, valuation of Nokia price, and second, I would be discussing with you this, I have uploaded already, weighted average cost of capital. And now we are almost done with valuation part. But I would spend one more session next week on valuation, maybe half of the session on valuation. But then I know that some of you ask about CAPM and other things with the real life data. In our next financial management lesson that we have next on Tuesday, no, on Wednesday, yeah. We will do, we'll carry on from beta that we did yesterday to calculation of CAPM as such with the real data. I'll keep the same company. I think I stick with Nokia next week also. All right. That's it from my side for today. If you have any questions, please stay back. If not, then thank you very much for being so patient as always and for your active participation. Thank you very much, folks. Let me see if they have any response, then I'll get back to you. Okay, so if you have no query, anything, then I close the recording and I close our meeting as well.
Thank you very much, Shab.
Thank you. See you. Bye-bye.
Bye.
Well, Shab, I have a